Welcome everybody. Welcome to the live stream. We're starting right now. Hello everybody. Welcome. We're starting right now. We are live. Yes, we're gonna be here for a long time, maybe 1 hour. So if you're watching, hello guys. How are you? Do not mind the hair. Yes, we're starting. Today is a Monday. Maybe this week we're gonna have, I don't know, maybe 2 or 3 live streams. It depends. Usually, I like to keep it to a minimum of 2 live streams. Okay. So if you're new here, please make sure you hit the sub, follow. Yes, here it's Smart Investor. So please give Smart Investor a support, show your support via following or subbing to this account, and also just staying in the live broadcast. Yeah, I know sometimes it can be boring, just speaking about this stuff. But the reason why I launched this account is for investment. I always say this whenever I come on live. I'm not a very mature investor. I haven't been in a game for a long time. I've just been in the investment game for um, a good amount of time. So the reason why I started this was just to motivate you guys, to give you hope, and also to help you guys to grasp what investment is all about, and also to uh, kind of give you a guide on how you can begin investing. So that's out of the way. So give us a follow, give us a share, stay in the live stream. We're gonna be also producing more precise content. You're gonna be seeing that the quality of our content is gonna be changing. It's gonna be becoming better and better. Okay, so if you're looking forward to have better live streams, or to have more high quality stuff or information, please kindly hit us with the sub. So they're just going to do a rundown of what we spoke on next week. Tomorrow, definitely, I'm going to be starting on something else. But to yesterday, last time, we did speak on things such as growth stocks and also income stocks. We did discuss, um, I think we spoke on investing, what is investing and what is speculating. We also did touch on a number of other issues um, that we did. So you can see we have a quote in the PPT. It's by Peter Lynch. Peter Lynch is a very famous investor. So they just quoted this quote: in the long run, it's not about how much money you make that will determine your future prosperity. So it's not about how much money you make that will determine your future prosperity. It's about how much of that money you put to work. Okay, it's about the amount of money you put to work for you, the amount of money you put to work to birth or to create new money. Okay, the old money creating new money. So that is what investing and saving is all about. Okay, it's not just having money and making it sit in the bank while inflation is hitting outside there and interest rates and the likes. It's about putting your money to good use wisely. We're trying to do the same over here. So that is Peter Lynch. Now let's go on to the next one. So yep, it's a worthy statement. It's a worthwhile statement to think about, to meditate or ponder about. Okay, it's not how much fortune you make, but how much of that fortune will enable you, will work to your advantage, will work to your pleasure by what? By creating more money and more opportunities to grow your wealth. So basically, that's all we have, guys. So yeah, so we're gonna be talking about what? We're gonna be talking about two main approaches to owning stock and investments, understanding what investments are or is, and personal pitfalls to prevent. So this is just the stuff that we're going to be talking about. So there you go. Two main approaches to investing, to owning stock and investment, understanding an investment, and personal pitfalls of investing. Yes, investing does carry risk. Risk is the reward that you take upon for being an investor. So, but even though we succumb to risk, there are some stories you can learn from other people to see how we can avoid those pitfalls. So in a nutshell, that is what we're just going to be talking about. Let's go ahead with the broadcast. So the idea of investing. So picture investing is an idea, okay? It's an idea, it's a science, okay? Investing money is the process of committing your resources in a strategic way to accomplish a specific objective, okay? That's Alan. It's another quote. It's all about accomplishing some set objectives that you have for your own personal life. For a lot of people who are not professional investors, usually some people want to save or want to invest for retirement. That is the simplest reason or the simplest objective that people want to accomplish. I want to have enough money for retirement, because we all gonna grow old. We all gonna get out of the workforce. We all gonna, when we get old, yes, maybe our children might support us. If you come from a culture where children support their parents in old age, but if you come from a culture where probably you're not entitled to have that burden to take care of your parents, then it means that you have got to have some sort of savings or investment that will support you through your last days on earth. Okay, and trust me, guys. You do not want to burden anybody with finances, because already, guys, life is hard for a lot of people on planet Earth. Life is already hard, okay? So you do not want to burden the next person. You don't want to burden your children. You do not want to burden your siblings. You do not want, these are things that you want to make sure that you sort while you're still healthy in your productive years, like now, in your 30s, in your 40s, in your 50s. Okay, these are some of the things that you need to address before your body starts failing you, because guess what? You're going to grow older, your body's going to start failing you. Yes, you will succumb to many diseases and many illnesses and sicknesses as you age. Your body's not going to be able to hold up like it used to. So why not use these productive years that you have to come up with some sort of investment? Easy peasy. That's why we're here. So you have to hit me with the sub over there, and we're going to be just talking about, okay? So we want to accomplish that. For a lot of people, investing for retirement, to have enough passive income, okay, to have enough income streams that will give you 10,000, 5,000 each and every month, or give you 20,000, 30,000 each and every month while you're seated at your home, or maybe taking care of your grandkids in your old age. Okay, you also want to travel, because some people, that might be their objective. Like, you know what, when I retire, I want to travel because I worked my what off. Yes, so I deserve to travel in my old age, because I didn't travel when I was during my productive years, because I was working. Okay, so you might save up, you might invest, you might want to have some passive income, you might want to have some streams of income to give you lots of money that in your retirement you can travel, okay, and take care of, and just be a grandmother or a grandfather, take care of your grandkids and stuff like that. So there you go. There should be an objective, okay? Committing resources. Well, what are those resources? It's money, okay? It's money. Money, you got to convert it. Whether you want to, depends on the asset class you're going for. Are you going for stocks? Are you going for bonds? Are you going for real estate, commodities, you name it? There are lots of asset classes. Okay, so let's move on. There we go. Why do we invest? What does that mean? Okay, we've already that. You should know why you're investing and what does that mean. Okay, so investment. We invest because investment. We hear a lot about it. We invest because we want to accomplish something. Okay, we usually invest because we want to create more streams of income. Okay, we want to have a cushioned life. Okay, little money is not good money. Okay, even though it's money, it's not good money. Little and enough money is never sufficient. You know, you want to have more. You want to live in abundance. So for a lot of people, they invest because they want to live in abundance. Okay, you want to come to a time in your life where you want to live in abundance. Okay, you don't want to live in scarcity. You do not want to live in lack. So you want to reach a point in your life where you want to live in abundance, abundantly. So sometimes you have to invest. You have to invest in a portfolio. Okay, you have to invest in a long-term strategy. Okay, you have to use long-term strategies to invest. Okay, so that's what I'll say. So as also you're gonna see that what investing. Okay, give me a second, guys. I want to do something. I noticed that I didn't put something up here. Okay, please bear with me. Just 2 seconds. Yeah, we want to. Okay, who's joining the chat? Make sure that you follow, make sure that you stay in the chat room. Welcome. This is Smart Investor. If you have the time, please tell us who we are. We would also want to know you. Plus, please help us support this channel by subbing, okay? Give us a subscription, follow us, and let's get on with it. Okay, so guys, give me a second. I just need to put something up. Okay. I have something up. I realized that there's something that I didn't. Okay, just give me a second. Who's watching right now, guys? How's your day going? How's your week? I trust your week is good. Mine is perfect. Okay, we are always here. Let me see. Let me see. Let me see. Mama see, mama sa, mama kusa. Yep. Okay, give me a second, guys. There is something I have to. Okay, there we go. Okay, I'm back. I am back, baby. Okay, so there we go. Why do we invest? There we go. Yep. Why do we invest? We already addressed that. So let's move on to the next one. Okay, let's go. So you got there, we've got a graphic. There's investment dollars. They're going into XYZ Corp. And then what are your returns? You got two returns, that risk and potential returns. Okay. So once you invest, you attract risk. Okay. Okay. Be equipped with the understanding that once you invest, the other thing that comes back to you is risk. Okay, it's unavoidable risk. So every investment involves risks. Okay, every investment. Okay, all these billionaires that you see, every investment involves risk. It's really the only guarantee of investing. Okay, so that's the guarantee. Okay, when you invest, you get risk. Okay, but you obviously are not you have other expectations, right? A return on investment. Yes, there will be returns on investment, but there is also risk. Okay. So yeah, so we have companies go bankrupt. People may fall out of love with the product. Okay. Interest rates change. Okay, all of which are out of a person's control. Okay, these are this is just the market. This is how the market behaves. This is how investment works. Okay, these are not things that you cause. Okay, okay, we cannot control these things. Okay, and they do negatively affect investment. Yes, they do. So you have to be an investor before you start investing. You should do your homework. You should do your research. You should try to understand. You should grasp on these important concepts that, you know, when you are investing, apart from just getting your return on investment or potential return, you are also holding on to risk. Okay, you're also holding on to risk. So I hope that is clear. Let's move on again. Investing is about getting paid to hold on to risk. Okay, you get paid to hold on to risk. So you give them your money, and what they give you risk. Like hold on to this risk, okay? Hold on to this risk, okay? And you gotta get paid for holding on to that risk. So in a nutshell, that way is what investing is all about. Now let's see, let's go to the next slide. Okay, now we got a little graphic there, people. We've got on one axis we've got returns, on the other axis it is risk. And yes, so graphics are an important way to illustrate what's really going on. So you can really see that we've got a green line there. The green line is, yeah, you can see that it's pretty much incremental. You know, it starts low, so your returns might be low, but over a period of time, you expect your returns to be what? To be high, okay? You expect your returns to appreciate, and also the same can be said for risk, okay? At initially, the risk is small, okay? The risk is, you know, you can laugh about it, but over time, maybe the risk might increase, okay? So as your returns also increase, the risks also increase, okay? So you can really see that this graphic is proportionate, okay? The return and risk are proportionate to each other, okay? The more risk an investment has, the more an investor should demand for a, so this is a hypothetical, the more risk an investment has, the more an investor should demand for a return, okay? Demand for a return because it's risky. So the returns also should be quite valuable. Okay, the monetary side of the returns, because you're holding on to this risk. Okay, a lot of risk. So the monetary side of it on your return should also be of the same magnitude or of the same level. Okay, so there you go. That is, the more risk an investment has, the more an investor should demand for a return. Okay, so it is your right. So this is just the art of basically knowing how to invest. Okay, if a person is getting paid for taking on risk, investors should demand that higher risk provide the potential of higher returns. Okay, so investors should demand that high risk has a potential for higher returns. Yes, yes. So let's move on to the next one right now. How are you guys doing? Do I have anybody right now? We're 16 minutes in. Some of the slides, guys, are just gonna be run through them. This is the same with bank. This is the same thing banks do with loans, right? So you go to the bank. It's the same concept. You go to the bank, they look at your credit score. They see that your credit score is low, and according to your profile, you have the potential to default on a loan. So they're going to charge a higher interest as what? As their assurance. Okay, yes, yes. Okay, they just be like, okay, we're taking on risk. Okay, we're taking on this risk. Okay, you have a low credit score, and we're taking on to your risk. We're taking on your risk. We're taking on such a heavy risk. But what? The thing is what? You must what? You must pay a lot of interest, okay? So that's just how it works. Look, okay, there we go. Okay, we see high risk. This high risk, high return model when banks give for loans, the low credit score tells the bank that you're at great risk of default on the loan. To make up for the risk, the bank charges a higher interest rate. Okay, the bank will charge a higher interest rate. Okay, there you go, guys. Okay, there we go. So it's the same. Bank is taking on risk of your potential, your credit score. You might default on your loan. So to make up for that risk, okay, that you might default, then they will have to charge you at a higher interest rate. This is just how life works. Okay, I didn't write the rules. Somebody wrote these rules. Okay, so let's see. Let's move on to the next. Okay, the goals of investing. So what are the goals? I think we've already spoken about this. Yep, there you go. The goals of investing. Okay, we all know Warren Buffett. We have something. We got a statement here, or a statement by Warren Buffett. It reads, "Your goal as an investor should simply be to purchase at a rational price." Okay. Okay, investors should purchase at a rational price. A part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Yep, so we have a statement from the great Warren Buffett. Okay, he had what is called as Berkshire Hathaway, which is an investment group valued or worth over $300 billion. Okay, so this is a seasoned investor. This is somebody who's been investing for decades upon decades. Okay. So Warren Buffett, one of the most richest and successful men on the planet Earth. So rationality, speak on rational price. Again, easily understandable business. Okay. Try to invest in things that you understand. Okay. Things that are straightforward. Okay. You have a little bit of understanding. Okay, there we go. Find investments that compensate you well for the risk that they have. Okay, so you gotta find investments that will compensate you well for the risk that they have. Okay, okay. So if you're somebody you notice you're like, okay, I can take on this risk. Okay, it seems high, it seems moderate. Let me take on this risk. Okay, so it should be an investment that compensates you well. Okay, very, very well. Very, very well. Exactly. The main goal of investing is what? Is finding investments that efficiently compensate you for the risk that they carry. Okay. So you're gonna carry a lot of risk. You should get the same compensation as well. Okay, the compensation should be major. You can actually tell from the graphic as risk increases, the return is also increasing. This is sort of like a hypothetical of what the mindset should be like when you're getting into investing. Okay, avoid holding extra risk that does not compensate. Okay, yes. If risk does not compensate, stay away from it. Okay, stay away from risk that does not compensate. It's as easy as ABC. Yep, yep, yep. Okay, if you take on a lot of risk that compensates you immensely, then take it on. Okay, if then, but do not avoid holding on to risk that does not compensate. Okay, because it will damage you. Okay, it will damage you emotionally and financially. Okay, definitely. And actually, this is applicable in life. Okay, this is applicable in life. Okay, okay. Understanding is important. Okay, there you go. Let's go on to avoid risks that you what? That does not compensate. Otherwise, you're just wasting your time. Let's go. So you can tell even from the graphic there. Okay, you can see now the risk. There's a lot of risk there, but there's not a lot of returns. Okay, according to the graphic. Okay, there's plenty risk, but there isn't that. The return is still low, but the risk is still just going. Okay, the risk is still low. The risk is high. Okay, but the returns are low. Doesn't work like that. Okay, let's move on to the next one. Ultimately, the goal for most is to save enough for a good retirement. I did say that when I started. Most people, they want to save up or they want to invest for a good retirement. Okay, we all want to retire one day. Um, yep. You want to hang your boots one day. Okay, you want to hang your boots. Well, do it in style. Have an investment ready for you. Invest now so that you what when you hang your boots, your investment will be waiting for you to take care of it. Okay. So let's go next one. Yep. Next slide, I guess. Okay, there you go. Yep. Ultimately, the goal for most is so. Yeah, we might not. So this is the most. This is the general view. This is the majority view. most people want to save or want to invest enough for a good retirement. Yep. Uh, Yes, but this is not everyone's goal, okay? It's not the reason why some people save or invest. Some people, most people, good retirement, to have abundance in retirement. Other people, it's for other reasons. Well, they want to create more wealth. They want to create more avenues of wealth. Some people are planning on a huge purchase that requires a lot of money, okay? So some people might actually entertain the idea of investing, holding on to risk, and getting compensation for over a period of time, and probably sell their shares or their investment once valuation goes up, thereby creating a lot of money, earning a lot of money, and then purchasing something. Okay, there you go. Let's go. Let's go. Let's go. Let's move with the presentation right now. Let's go as well. So you can see on the graphic, on one axis, we have what? On the X and the Y, we've got the X and the Y axis, we have returns and time. So you see the relationship that's there. Okay, money, money, money at the end of the day. Let's go, let's go. Okay, so Benjamin Graham, for your own information, guys, he is the mentor to the one Warren Buffett. He's father of value investing, professor and mentor to Warren Buffett. Okay, he has a book that is called The Intelligent Investor. I would have put the image there. Okay, you can go Google Intelligent Investor and it's gonna come out. Okay. Okay, Benjamin Graham, the Intelligent Investor. You can even go PDF and you can get a free one nowadays. Okay, it's got 641 pages. Yep, it's a big book. Okay, it's a big book. So go check it out. So, yep, that is a quote from the one Benjamin. Yep. There we go. Market gambling. So the individual investor should act consistently as an investor and not a speculator. Okay, what a strong sentiment from Benjamin Graham. Okay, so that's how it should work like. So we're now going to enter into market gambling, okay, because the marketplace is unpredictable, okay? This is something that you should get into investment knowing that the market is unpredictable, but there are ways to mimic the market. There are ways to foresee how it's going to go, to forecast the market. That's why we have research, and that's why we have books, and that's why we have professionals. But not one person will ever say that they know the market entirely, because the market is its own organism. It behaves according to its set rules. Okay, we are just there to determine and to be smart about it. Hence, I named the channel what Smart Investor. Okay, we will need smart investors. Yeah. Okay, so there you go. Many people have got the view that many people hold the view and they say what stock market is just a form of gambling. Okay, taking chance, right? Okay, luck. Okay, a stroke of luck, gambling. Okay, we're just gambling. Gambling has got there's nothing that you should really do. Okay, it's just taking your money and just placing it on a bet or gambling. There is no prior information, there is no research when it comes to gambling. It's emotionally driven. You've formulated in your mind, or you've seen, oh, okay, I'm gonna get a payday, okay, or hefty payday, okay. So it doesn't have any digging deep, so to speak. It doesn't involve any digging deep, so to speak. But now stocks are not like that unless if you are a trader. Okay, stocks and investors actually are shouldn't approach the stock market and stocks as a gamble or gambling, okay, or like you're playing poker, or like you're playing cards or something like that, or like you're at the casino. But many people have this view, okay. And what so calling is fairly common, okay. So this is a common viewpoint from a lot of people because investing involves risking money to make money, okay. So investing involves risking money to make money. So it's easy to see why people choose to think of it that way, okay. So that is the reason why people think of it that way, because what investing involves what risking money to make money. Yeah, risking money to make money. So let's go. Many people say that. Okay. So why isn't investing gambling? At its core, gambling is about purchasing risk and nothing else. Exactly what I did say is just purchasing risk. That's gambling. Let me gamble. Let me just purchase. Okay. And hope. Okay. Gambling is about purchasing risk and nothing else. Investing is owning financial assets. Okay, so when you're an investor, you own assets. You're owning financial assets. You are an owner. Okay, gambling, you do not own any assets. You own risk. Investing, there can be assets and risk at the same time. But the major thing is what you are owning financial assets that have the potential to produce value. Okay, that has the potential to produce value. So investing is a process or a process, big process there, investing, but gambling sort of like it's an event. There isn't much for you to think about when you're gambling. Okay. So there we go. Let's move on to investing versus speculating. So buying assets that will hopefully yield returns based on the success of the underlying business. Okay, that is what investing is. Just buying assets that will hopefully yield returns based on the success of the underlying business. So what is investors have a good reason to believe assets will grow and multiply in value while they hold them. Okay, so there is confidence from the investors that if I hold on to this risk, if I purchase this asset, it will grow in value while I hold on to it. And usually they are informed. Okay, they are informed. We're talking about people who read financial reports, people uh, who follow the news, okay, the updates and all of that. You know, people who've devoted their lives to have a deeper understanding of how the markets work and how companies work and how trading work takes place. Okay, so this is what this gives them enough good reason because they are looking at a company. There is something called what there is a history, right? A track record. It could be Apple, it can be, I don't know, Microsoft. There is a track record that says, you know what, they have a track record. That track record boosts confidence in your belief in the asset, that the asset will increase its valuation over time. Yep, let's see how many people are watching the live broadcast right now. How you guys doing? Kindly give me a sub, give me a like, stay on the live broadcast. Let's chit chat. How are you guys doing? Welcome, 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 welcome to the live broadcast. Okay, let's continue with the live broadcast. Make sure that you subscribe, make sure that you stay in the live broadcast. And also, guys, go and download the Intelligent Investor. Okay, you can get it, okay? Go and download it, the Intelligent Investor. You can get it. Just it's a fairly large book, but try to read through it. Okay. Okay, let's continue with the live broadcast. Okay, welcome. If you just joined us in, guys, we're talking about stocks and investment. We are discussing right now the difference between investing and speculating. So if you're joining us right now, we're just having a brief discussion on these two. Okay, are they similar or they're different? We're talking about investing. So let's find out what speculating is. Speculating is risking money with the hope of good fortune. Okay, there is hope of good fortune. You're not holding on to any assets. Okay, you're just hopeful that there will be good fortunes. Okay, just Like investing is like going to place a bet on a game or on horses. You just have a you hope that you will strike gold. You hope that you're going to be lucky. Okay, but now when we invest, it actually we they take our money and we hold on to something called financial assets. Okay, so risking money speculation is risking money with the hope of good fortune. So you're not holding on to any assets. Okay, the only thing you have is your hope and expectation that a good fortune will pass will find you. Okay, will locate you. So little if any evidence to suggest that assets will carry value or improve in the future. Okay, so there's little or no evidence that assets will carry value or improve in the future. Remember guys, investing is about what is about holding on to assets that what that will is holding on to risk, and you get paid for holding on to that risk. Okay, that is speculation and investing. Okay, okay, exactly. Investment, and there you go. Investing carries risk, but ultimately investors are buying into potential success of a company. If you're going to put your hard-earned cash at risk, you should have clear reasons to believe an investment will do well. You should understand what the asset is and why. Okay, there you go. So speculation, okay, speculation now is much closer to gambling. It usually requires finding the bigger fool who is willing to pay more for a questionable asset than you were. Okay, speculative assets are expected to increase in value simply because more people want them, not necessarily because. Okay, let's go back. Okay, let's come back. Okay, there you go. So yeah, so you notice that with investing, there's a lot of information that's got to get dug up. There's some understanding of what you're involving yourself in, the company that you've invested in, their product. Speculation is kind of hoping on a payday, right? Okay, so what's the problem with speculation? What is the problem with speculation? Welcome to our live broadcast right now. Do we have people? Let's see who is on the stream. We do not have a lot of people though, but we welcome you, those that are watching us right now, so you can see what's the problem with speculation. Speculation does not focus on the asset being purchased. Okay, so that's one problem with speculation. It doesn't focus on the asset that is being purchased. Okay. Okay, instead, it focuses on the returns. Okay, so speculation seldom focuses on the asset that we've bought. Okay, or trying to understand the assets. Okay, it focuses on the returns and asset. It focuses more on the returns the asset could produce if certain unpredictable conditions are met. Okay, focuses on what? On returns that asset could produce if certain unpredictable conditions are met. Okay, that is self-explanatory. Okay, so are you a speculator or are you an investor? Because you're gonna see in the next slides, we're gonna have some statements and want to see if you can be able to find out if uh, one of or two of those statements were said by speculative or speculators, or if the other statements were done by people who are investors. Okay, so yep, speculation still has assets, but we are primarily focusing on the returns. Okay, we don't care about the asset, we're primarily focusing on the returns and that we could earn or get when certain unpredictable conditions are met. Okay, so there we go. So now we're going to do a little quiz, a little game. We want to find out uh, what it's all about. Okay, so the first one is this stock is hot. Okay, this stock is hot. Would an investor say this or a speculator would say this? And what are your reasons behind this? Okay. Okay, so is this, so we've got a statement here, this stock is hot. Is that an investor who'd say it or a speculator? Okay. Mm. Okay, let's move on the slide. What happened? Oh, sorry guys, I had accidentally stopped my PPT. My bad, people. My bad. My bad, my bad, my bad, my bad. It's my bad, it's my fault. Okay. I hope is it showing, guys? Tell me. Okay, the stock is hot. Are we back there? Yeah, we're back. The stock is hot. Okay, let's move on. So that is speculation. That is a form of speculation because, yep, we are focusing on the conditions of the stock, right? Okay. What the stock, the nature of the stock in the near future, right? The stock is hot, and probably a lot of people are saying the stock is hot. Yeah. So let's see what is the next one. Okay, let's see what's the next one. Uh-huh. The underlying fundamentals of the company are solid. Okay, the underlying fundamentals of the company are solid. Okay, who would say this? A speculator or an investor? What do you think? The underlying fundamentals of the company are, so they're no more focused on the company and their foundations or their fundamentals, right? So who would say this? Okay, let's move on. Obviously, this is an investor or investing. Yeah. So it's a company. We have got to strip it clean and really know what this company is all about. Okay. Um, find out more. Okay. Remember, Warren Buffett says what? Also investing. It's what? It's committing resources. It's buying at a rational price. And the other thing is it's investing in a business that you understand. Okay. So it's also based on your level of comprehension. Okay. It's also based on your level of comprehension as an investor. Okay. And that's what we aim to do over here is to equip you with some intelligence of some sorts. Okay, let's see, move on. Next one. Emerging markets have been dropping for a while, so we expect to see a reversal soon. Okay, emerging markets have been dropping for a while. So who would say this? Obviously, this is speculation. Okay, let's go to the next one. The stock was overvalued, but now looks priced well relative to earnings. That has got to be investing. Bing, bing. So there you go, guys. There you go. Is there anybody watching right now? Yeah, so help me, guys. Help. Share the stream. Help stay in the live as well. How are you guys doing? We're talking about investment. Are you an investor? Are you somebody who wants to know more about investment? Kindly support this channel. Give us a sub. Okay, subscribe. And also, guys, make sure that you do not miss out on the content. We produce content every day, some videos. Sometimes we will live stream. Please make sure you support the channel. Uh, So let's go. Next one, the stock is hot. Definitely. There you go. So now we're going to talk about foundational investing concepts. So I'm actually going to dive deeper into this. Um, Foundational investing concepts. Okay, it's the very first concept you guys should know about. Okay, yeah, there you go. Just give me a second. Foundational. Just gotta type something. Um, Foundational investing concepts. Okay. Okay, so foundational investing concepts. Let's move on to this one. Good people, let's see. Okay, so we're going to talk about volatility. You always hear volatility, market volatility. So, what exactly is volatility? So, this is the amount of change an asset undergoes or is expected to go, the amount of change. Extremely volatile assets have prices that fluctuate greatly over a short term. Yes, volatility, market volatility. You can really see we have a graphic, okay, with a sharp upside and then also a steep downside. Okay, very steep. Oh my God, it goes up, goes down, goes up, goes down, goes up again. Extremely volatile. So this actually makes it a lot more difficult for people to sell such a stock, because according to this pattern, okay, because this is a volatile asset, these ones are a bit tricky when it comes to selling. But we will get into that as well. So there you go. Amount of change an asset undergoes or is expected to undergo. Extremely volatile assets have prices that fluctuate greatly. Okay. Okay. Volatility is equivalent to the amount of risk an asset carries. Okay. So volatility is equivalent to amount of risk an asset carries. Highly volatile assets have prices that are easily swayed by market news and investor interest. Okay, highly volatile markets, prices are easily determined by what? By market news. Anything that comes out of the market, then price is adjusting. Okay, price is rising or price is falling. And also investor interest. You might have a lot of people who are queuing up for this investment or for this asset. Hence, it's going to be like what? It's going to be very volatile according to the image that we have here. Now let's go now. Okay, volatile assets typically have a chance of providing higher returns, but they can also expose an investor to higher loss. So this is what you get when you trying to dabble yourself in what? In high volatile assets. Again, volatile assets. There you can see we have returns there, and we also have got what? We also have risk. Okay. Volatile assets typically have a chance of providing higher returns. So yes, volatile assets can provide higher returns, but they can also expose investor to high losses. You can see there, the red being loss and the green being what? And the green being the gains, okay, the gains of an asset, okay. Okay, so we can see an example of market volatility is in 98, 99, and 2000. We got two companies, two tech companies we all know, Amazon and IBM. Is IBM still around? Yeah, they should be around, right? They just changed their model, their business approach. Okay, there you go. You can really see that Amazon is the one in green and IBM is the one that is kind of like constant below. Okay, so IBM has low volatility. You can already tell. Okay, there are no sharp readings there. Okay, it's kind of like a straight line, not entirely straight like 90 degrees, But even if there was volatility, okay, you can't see any sharp increase or you can't see any sharp decrease as well, okay? It's just straddling down there like a straight line. But then when you look at the Amazon graphic, you can see it's highly volatile, goes up and then it dips down, takes a sharp dip, and it goes up again, down, up, down, up, down. So this is a highly volatile asset because you can see. So it's hard for you if you're not equipped with the knowledge or with the information. It's hard for you to even buy or sell that stock because you do not know. You can buy high and then you sell low. We're trying to avoid that, right? Yeah. But you buy high and sell low because of what? Because you speculated, okay? Hmm. So the risk associated with volatile assets, okay, we already spoke on this one. There you go. Okay, this is a graph of the percent change in value of Amazon and IBM over 3-year period. Amazon could have provided greater returns. Yes, you can see those sharp spikes up there. You know, can buy there at that point. You can sell. If you owning this stock, you would have sold there, but it's highly volatile. So Amazon could have provided greater returns, but only if you were lucky enough to predict when to buy and when to sell. Exactly. So it's difficult, according to this graphic, when exactly to buy and when to sell. Many investors who tried to play the tech bubble of the late 90s succumbed to loss. Okay. They suffered major losses. Okay. Now I'm going to speak on diversification. And also, guys, just give me 2 minutes. Just want to open something here to do with this lesson. Okay. So if you're joining us for the very first time, guys, please kindly help us with a sub. Okay, follow the channel, follow the account. So the next slides, I'm just going to be reading them. Not much explanation that I'm going to be offering. So we now have diversification, building a portfolio from numerous assets to reduce its overall level of volatility. Okay, we want to avoid losses and volatility. So it's wise enough to build like a portfolio. Okay, portfolio. There you go. Diversify your portfolio to spread the risk. So diversification can increase the efficiency of risk return relationship in a portfolio. So you can see where the diversified portfolios are, right? And where individual stocks and bonds lie. Okay. So there's a big gap right there. Okay. Let's move on to the next one. So investments that aim to make use of diversification are exchange traded funds, also known as ETFs and mutual funds. So these are the investments that make use of diversification at a larger pace. Okay. These allow investors to own shares of a larger portfolio made up of many individual investments. Yes. Let's go. Value versus growth. So maybe we're going to end here today. If you want the PPT, guys, please tell me and I will put a link in the description of where you guys can get the PPT. Okay, just tell me, guys, and I'll provide the link to the PowerPoint presentation. Okay, so there you go. Value versus growth. Okay, two approaches to picking assets. Okay, value investing and growth investing. Okay, so I did speak about this one last time. I think we're gonna do much more of value investing and growth investing. I've been getting a lot of requests to do that. So value investing is targeting assets who've lost their value, but that assets that have lost their value or assets that have devalued but still possess potential to regain their value. Okay, so that is what we call what value investing. Value investing. Okay, it's devalued, we see it, we buy. So when it's devalued, obviously maybe a lot of people don't want to buy it. Okay, but somebody takes a risk and buys it after being devalued in the hopes that over time it will regain what, with confidence, not just uninformed. You're informed, you're on the ground, you're understanding, you see, you're well informed, and you know that it's just a matter of time. This asset will regain its value or even go beyond its previous highest value. And then there's growth investing, where we're just committing into something that we have no knowledge of. Okay, there you go. So let me see, go to the explanations. Okay, so value investing is just purchasing assets believed to be temporarily undervalued. Okay, value investing, purchasing an asset believed to be temporarily undervalued, okay, or out of favor with investors. So it's an undervalued asset. It's fallen out of favor with investors for whatever reason. We do not really know what the reason is. And then, so that's actually pretty self-explanatory. And you can see from the graphic there, its previous value is in what? Is in gray. It's tumbling down, and you purchase it at that point, and then after you purchase it, the value starts increasing, not as soon as you purchase it, but according to how the market will, you would have like forecasted the market. So you can see now it's going up, it's going up. Okay, it goes above its estimated value and it keeps going up. Okay, so that is value investing. Now we've got what? Growth investing. So purchasing assets that are expected to have a bright future and see expansive growth. Okay, expansive growth. Mhm. It's purchasing assets that are expected to have a bright future. Okay, so yep. Again, this comes to what? To holding on to risk. Okay, it has a bright future. Probably doesn't have a track record as such, but obviously the fundamentals, it is what prompts us to say, you know what, we're gonna put our money in this asset. Okay, expected to have a bright future and see expansive growth. We do have many companies like that, the Tesla and many other companies that have already surpassed that bright future and have actually like have grown exponentially. Okay, and expanded at the same time. So purchasing assets that are expected to have a bright future and see expansive growth. Yes, we always want to invest in such assets, especially if we're going to hold onto the asset and hold onto risk. We want something with a bright future that will grow, that will even grow 100-fold. Okay, definitely. Let's go next one. Income versus growth. Got more graphics. I usually like to put some graphics. Regular income stream from bond payment or stock dividends. You can see it right there. Profits from selling investment for more than they were purchased for. Okay, let's move on. Pitfalls we create for ourselves. Yes, so we are now at the pitfalls. Yes, so it is important for you to understand that there are pitfalls. Okay, we'll add here. Maybe now we will add and here. So it is important to understand that we have pitfalls. So we got that statement by Warren Buffett, a quote: there seems to be some perverse human characteristic that likes to make easy things difficult. Yeah. And he called it perverse. Okay, perversion there. That likes to make easy things difficult. Okay, so there you go. We're gonna end here, guys. 1 hour. I would have gone on and on and on and on. I will try to pin this to pin this to include this PPT, the link, so that you guys can get a hold of it and also get to. But let me just skip through, and you guys can see there excitement and fear, what to do, patterns. You can see all of these things. This is now behavior now. This is now investment behavior. You can see very, very detailed and informative. Okay, there we go. So it was good, guys. Thanks for joining the live broadcast. Yep, it is always a pleasure to come here and talk about this, guys. So make sure that you what? You follow, make sure that you share, make sure that you stay in the live stream. We'll see you next time, guys. Goodbye.